All right. What is up, everybody? Joe, you're frozen.
I was gonna say you're
All right.
frozen for me as well. I was like, oh, that's off to a good start.
Yeah, dude. No. That. All right. So, yeah, we haven't done one of these calls in a little bit, and we were just talking. So I'm like, you know what? We're gonna be more consistent with some of these things, and maybe daily, for sure, weekly. But just talking about things that we're seeing in the market. The last week or so. I mean, just to share charts. Sorry, I didn't
Hmm.
mean to say that.
Let's not
Uh,
share those.
Yeah, dude, it's dad life. You spend way too much time with your kids, right?
Yeah.
But let's look at this real quick. I just want to share this screen with everybody. And we're recording this. This will be posted today. But what I wanted to do was just look at the markets and the overview of what we're seeing. And it was funny because I was like getting upset about this because there's a lot of things that are crazy these days. And I think a lot of it's driven by media because it's clickbait. I mean, it's funny. I was at a church 3 weeks ago, I believe it was, and the pastor of this church basically said, being on social media, what are they doing? They're causing anger, and anger is not necessarily something that is good. I mean, there's good forms of anger where it's, if you're upset about something that logistically makes sense for good reason or in morale, if you will, then sure, be angry. But what they're doing with clickbait, of course, and we see this on both sides. I'm not going to say, the right or the left, but this is definitely a great representation of it, which is why I'm sharing my screen, is they're creating this whole havoc on headlines. And what I've seen over my career in 24 years of doing this, we tend to see things move slower based on actual numbers, basic statistics, basic things that come out that are really part of your inflationary figures, your what's going on with jobs data, right? So what unemployment looks like. We see it with, a report that came out last week called the consumer sentiment number, which came out. And so that's kind of what I was leading into. And we heard that the Fed may raise interest rates. It's all over CNBC, CNN, and even Fox, right? So again, this is a bipartisan approach to this thought. We're seeing this today though, because now we're coming in and Joe and I were talking about, it's like, you know what, let's record this so people actually get it. But this is MBS Highway, and they're actually showing charts. I subscribe to this service. And if you're a loan officer that doesn't, and watching this, I want you to subscribe to this. This is a very good service. It's huge. But what we're seeing is the consumer sentiment number came out last Friday. And so what we did see leading up to this is of course, this is, March 2nd. We see these numbers here. We had alert to lock on the 12th. Basically every day an alert to lock. We had another one on the 18th, a huge number here. This giant red stick, not a good thing, actually a very bad thing. We lost, I think, 60 or 70 basis points. And then, of course, you're coming into March 26th. And then now we're seeing this big green number, which is a huge number, 41 basis points. You see the treasury is down by 10 basis points. The reason why I wanted to start by sharing this chart is just explain something. And, Joe and I were talking about this, and Joe, of course, you're asking me questions on this, but what I said is, okay, this weekend, and I'm just going to go there and forgive me for everybody. And don't think I'm a supporter of Orange Guy because I'm not. Right. I mean, however, we had a No Kings protest, and a lot of it was driven by media. And you see more social media, and it's making you angry, and it's clickbait. So people are clicking it, they're getting riled up, they're getting angry. They're really causing more harm than good. And granted, we haven't had a king in 250 years. I've seen posts on that on both sides of the party, whether red or blue, which is interesting. It's an interesting thought. But my point in saying this is looking at these articles that were published by CNBC, CNN, and I think Fox even had saying, okay, Fed rate is probably going to raise rates because of what's been going on. And, we're having this, you know, harm or concern of inflation. However, now we saw the consumer sentiment number, which came out on Friday. And now we're seeing the response to that number, which is causing what I just showed on my charts was 41 basis points of an improvement with mortgage-backed securities. We're seeing the 10-year treasury, which is at 4.5, coming down to 4.33 this morning. And the reason why is really, this is the thing to remember. That is not really the truth, right? We're not seeing the truth here. We're seeing consumer sentiment, which is really the consumer saying, I am looking at necessities. I'm not spending on things I don't necessarily need or want, but they're locking down. Of course, oil being a big contributor of that. So you're seeing these numbers. And what's interesting of this, if you look at these charts, it looks not inflationary. but rather deflationary, even recessionary, which would then mean that the Fed chair, if Powell does this, and Powell, I believe, is out next month, right, would be making a catastrophic mistake. And we saw this with the ECB. A lot of people don't know this, but we did see Jean-Claude Trichet, I believe is how you say his name, in 2011, did this with the ECB. They had a similar thing with the European Central Bank. When they did that, of course, you saw inflation and things get worse. He, of course, steps out or steps down. Then you see Draghi come in and he fixed things one rate cut after another just to get the thing to calm down to help those that countries that were involved with the ECB. Of course, after that, a few years after, we saw Brexit, which was Britain stepping out of, that whole union, if you will, between them. But now we're looking at something with oil. And I'm not diminishing the oil costs. I live in California. Trust me, I get it. Gavin likes to tax us. We're seeing more oil and gas expenses than most of the actual country. But if you look at it from a grander scope, you're saying, okay, what is that going to do? What is the Fed or what should the Fed do in relation to that? It's more likely a rate cut. So if we see the possibilities of a rate cut come back, you're seeing treasuries calm down. You're seeing mortgage-backed securities giving yields in the green. That does mean that you're going to see actually probably more interest rates improvement, right? Or more interest rate improvement. And as I share that, one thing I want us to think about is it's more than likely it's going to be gradual. Nothing moves in a straight line. Everybody's thinking, oh my goodness, we're going to see rates back in 5.5 to 5.875 as we did last month. I'm not saying that. What I am saying, it is gradual improvement for where we were or we're going to, because it looked as if we're headed towards a 7% 30-year fix again. It's more likely we're going to calm down a little bit and improve. But Joe, I know you had a bunch of questions on this, man. So please ask away, bro.
Yeah, thank you, Mike. Because my thing is, just trying to make sense of this all. So it seems like we're going back towards a more analytical uh reaction to the market versus like the whole headline approach to it, where the market reacts based solely on headlines. Because my thought was there had been a
Bro,
lot of sentiment recently.
yeah.
Oh, let's go.
No, no, I exactly right. Exactly right. What you're
Mm.
saying. I'm just getting excited. I don't know what you're saying. Too much caffeine and Celsius, bro. But bro, absolutely. I'm sorry. Continue.
No, that's pretty much it. Because yeah, from everything I've been seeing, and who knows, everything I'm seeing is, we want to get out of this. What's going on overseas right now. We want to get out of there as soon as possible, and we're trying to work out a deal. Who
100%.
knows? And so my thought was, if we're still kind of in that market where we're very reactionary, is that we're reacting to that. But now that you're kind of breaking it down with some of the reports that got released recently, that makes a little more sense. It's more data backed, which is
Yeah.
good.
Yeah, it's more dated back. And that's why I said 24 years ago when I was in the industry, we'd say, look at we'd get the paper, right? In San Francisco Chronicle or, when I was in Honolulu, we'd look at the, paper there or, even San Diego. I think it was the Tribune was in San Diego as well. It was a Star. Yeah, Hawaiian Star, I think was the paper there. But we looked at the 10-year treasury is what we looked at, right? So you watch that 10-year treasury and you're kind of watching that because you see that. Now, keep in mind, inflation figures or inflation is the arch enemy of mortgage-backed securities as well as the 10-year treasury. So you're going to see that cause that rise, right? As you see
Mhm.
inflation concerns. We saw that in the early 80s, right? With the Carter administration. We saw it with the previous administration. You did see inflation calm down, as we started this current administration or even the tail end of the Biden administration. We did see things calm down. And I'm not marking the administration, but it is how you print money. So if you're a government that likes to print money, you're actually doing something to the cost of the dollar itself. Since we actually have a currency that is what we call fiat currency, you're basing your currency off of the strength of the economy. Now, if the economy is printing money, you're basically causing more supply than demand. As you print out more supply and demand, then you run into issues of, okay, what's the currency really worth? If you continue to hit control P, as I say, right, you're just printing, 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 that doesn't actually help anything. What does help is if you actually watch that closely, watch where your rate is, the Fed rate, if you will, which is, of course, the rate kind of in situations where you run into unemployment, you run into consumer sentiment issues, you're looking into, inflation to curb that to help cause things to come down a bit. Now, what's interesting is there is a report that also came out last week in regards to job sentiment. So if you look at the job sentiment, only 13% believed that we are not in an issue that would cause greater unemployment. So if you're looking at unemployment as a greater amount and you're seeing consumer sentiment slow down by a larger number, nearly 10 basis points of a change, which is very large when you go from something, actually it's 5 basis points, from 57 to 52, that does mean that things are slowing down, which does give a look or a nod perhaps of what we think about maybe a recession. a recession is looming. If recessions loom, and we've been looking at them, and we saw soft landing, we thought that for the last 3 years is what we kept saying, right?
Mm.
Remind me of playing Top Gun. You're landing the plane at the first at the end of that first level there. Hate to give the nod, but hey, I'm old enough to do it. But and I did land the plane once, bro, but I was like 35. But the point is
Better late than never.
yeah, I mean, I wasn't 8, right? The 8-year-old kids that did it are like prodigies and rocket scientists, probably working for Boeing now. But yeah, it's funny. As we see that though, you are seeing these actual news events come out. Now, the reason why I started all this and all my tangent of too much Celsius and caffeine is looking at when we look at true inflationary figures, that inflation is the true mark, right? You're going to look at, yes, you're going to look at consumer sentiment. You're going to look at the jobs market and see what unemployment looks like. These are true figures that could affect the bond market and in turn mortgage-backed securities, which in turn can affect mortgage interest rates. So if you get a headlines, and this is why I gave the job to the headline news, all of it really. They're doing it why? To clickbait, to cause anger, to cause frustration, to cause fear. And as they're doing that, you're buying into it, not saying you are, but let's say a general
In
populace,
general.
and they're drinking the Kool-Aid, so to speak. Jim Jones nod, not saying you're drinking the Kool-Aid like down south. That's weird too. But as you're doing this, you're actually believing these things or buying it, which is causing more fear, commotion, and actually making it go viral. And then you have something like this Friday that the truth comes out. And so when I say that, it's interesting to think about because click does cause anger, frustration, and fear. As it does that, it's selling more. What's it selling more? Product, Nielsen ratings, reviews, views, clicks, shares. These things that are actually essentially creating greater views and revenue for those entities rather than actually true things that are happening. So the one thing we have to remember is look at the true value of things. Remember, something's in the dark until it's brought into the light. Once you don't know and you get the actual report, it's very easy to look at it and you look at a day like today, and I'm going to show the screen again. We're starting to see some major improvements, which is good for people either looking to purchase a property and maybe in time refinance, right? So this would be something good to look at and say, okay, now we have this report out. Now we're seeing these major improvements. We're seeing 40 basis points right here on mortgage-backed securities. The 10-year treasury is down by 10. When it did touch about 4.5 last week. We saw all of these numbers of what we say on our industry, alert to lock. Now, if you're unfamiliar, and I know many of you may be, an alert to lock is when we have an interest rate or we're watching mortgage-backed securities, which is going to cause that interest rate to go up. News that we hear does directly affect conventional, jumbo, FHA, VA rates. And in time, of course, we'll see it with non-qualified mortgages like your bank statement loans, profit and loss loans, your DSCR products, things like that as well. So if you're watching this closely enough, you're seeing this giant green number here, and there is some room to make, there is room here that you could see further improvement. And if we see further improvement, that means that things could actually further improve, which would then mean we're going to actually see better interest rates again. I don't know if it's going to go to 5.5, 5.75. Seems like we're just in that market a little bit. It is more likely we may hit the lower 6% range again soon. So this is what we watch on a daily basis. But I did want to talk about what the media does because I think it's important to understand it's okay to read the media. I mean, I grew up in a family that got the newspaper, the Marin Independent Journal, and the San Francisco Chronicle every single day. The IJ showed up in the afternoon, the Chronicle was there in the morning. And I saw my grandfather reading that paper every day. There's nothing wrong with reading the paper. Trust me, there's not. However, it's important to understand the sources that are producing that. If you're watching news media today, are you watching the news like we grew up with, or are you just watching commentary to help, again, sell those Nielsen ratings?
Yeah. It's really hard to kind of find a news outlet nowadays where you can really, you kind of have to go through all the facts, like you said, and just really dig to see what the truth is, honestly.
100%, dude, 100%. So as we look at this week, it is Monday. I wanted to do a market analysis real quick just to share with people like, hey guys, watch the market. If you're looking to purchase a property, don't be scared of this market. Quite honestly, this is probably an opportune time because there are plenty of buyers that are stepping in the market because of, again, fear, concern. Oh, we're going to see a great recession. We're going to see home prices drop in value. It's more than likely they're not because we're still seeing multiple offers, even in this market, even last week when rates were starting to go up a little bit. So I'd share with you is stay vigilant, stay out there. If you're already working with the team, continue to stay in touch with them. If they follow up with you consistently, they're doing a great job, but make sure that they go over what things are looking like now that interest rates may be a little bit higher than what you may have been pre-approved for a month ago. If not, Hey, Joe and I are here. We'd be happy to help you, right? So that's a little plug. But any more of this stuff, let us know. Feel free to share this and definitely give us a follow. We're here every step of the way, and I promise we're going to record more of these, right, Joe?
Absolutely.
All right, brother. Hey, y'all have a blessed day and happy Monday.
Take care, guys.